as always,
Hi.
for agreeing to share your knowledge, your wisdom with us.
Hi, Charles. Good morning.
Okay.
Thank you for your kind introduction, and also good morning to all our attendees today.
All right. So as I mentioned a while ago, we're going to try something a little bit different. So throughout the presentation, I'll be asking my questions. I'll be butting in to ask some questions to help the flow of the outlook. Okay. So I'm going to start right off with the first question. Okay. So April, at the start of the year, you mentioned that the Philippine market has what it takes to sustain its strong performance. So in fact, we were all expecting that the Philippines could continue to outperform the US market. However, the past 6 months has proved to be a little different than what we expected, right? So what went wrong?
Okay, so let me just share my screen. Yeah, so I think for the year to date, at least, the PSEi has significantly underperformed, being hardly changed. But you can notice during the start of the year, we were very strong, whereas the US looked like it was underperforming. But that has changed. And for the year to date period, the S&P 500 is up by around 19%, whereas the Philippines was, has languished or after that strong January. And there are many reasons for that. Remember, one of the things we talked about in January was the strength of China, the excitement towards the reopening and what it meant. Unfortunately, that has been a big disappointment. Secondly, I remember one of the things that people were really excited about in January was expectations that the Fed would finally start cutting rates. In fact, the initial expectation was that rates would be, I guess, by the end of this year at the 4% level. But unfortunately, that did not happen. In fact, there is a stronger likelihood that the rate would be above the 5% level by the end of the year. And because of that, instead of the peso strengthening substantially, or say the dollar weakening, we saw the dollar remaining stable. And in some ways, that kind of encourages fund managers to stay with dollar stocks. And I think the final reason why investors are super excited about the US is because of the popularity of artificial intelligence, or AI, thanks to ChatGPT, which was launched in November and is one of the most popular apps right now. I think the major catalyst for that is the favorable earnings guidance of NVIDIA, saying that, hey, demand for our chips is so strong because so many companies need these chips to have AI as a functionality. So because of that, US investors were thinking, maybe inflation is not going to be a problem because we have this productivity tool, etc. So yeah, I mean, those are many reasons why investors are, I would say, more optimistic on the US and more pessimistic, or they've ignored the Philippines. That's why we're just staying sideways.
So yeah, so it seems like they're prioritizing the US market for now, right? So it begs the question. So you mentioned a lot of change, right? So the question is, have you changed your mind about the Philippines outperforming potentially going forward?
Well, that said, I have not changed my mind. And let me just share with you why. Why I think the Philippines can still outperform the US. And there are many reasons. First of all, I'm not of the view that, or I don't agree with the consensus view that the US economy is no longer at risk of entering a recession. Therefore, there will be no more bear market. I think both are still possible outcomes. Secondly, I think the Philippines has better fundamentals compared to the US. I mean, the reason why we were positive in January, I mean, those factors are still there. And of course, valuations are still cheap, and foreign investors are heavily underweight in Philippine stocks.
Okay. So let's focus first on the US side, no? Because I think with the, with the recent rally in the US market, and a lot of people are already, or at least the consensus are already lowering their odds of a potential recession. So you're a little bit on the other side, non-consensus view, right? So could you explain what you think are the risks to the consensus bullish view of the US economy?
Yeah, okay. Yeah, so we try to look at what happens, what are the sequence of events that happen before a recession materializes in the US. And why is it taking so long? Because you think about it, since January, people were talking about a recession and investors were super bearish during the start of the year because they were anticipating a recession. But of course, it's not happening, right? Well, we did a study of the sequence of events that would lead to a recession. And I think the main conclusion is recessions recession is still a risk as rate hikes work with long and variable lags. Now, we looked at the Fed rate hike cycles since I would say 1950s, and we tried to study. I mean, since the 1950s, where every time the Fed increased interest rates, there were only 3 instances when there were no recessions. Okay, so I think it's the 1970s, 1980s, and 1995, no? But anyway, what we notice is what happens is first, inflation goes up. And of course, the Fed raises interest rates to control the inflation. And the only time when a recession did not happen was when the yield curve did not invert. Okay, every time the yield curve inverted, there always is a recession, or always was, implying that, oh, the Fed over-tightened, probably. That's why it led to a recession. Or maybe inflation was too sticky such that the Fed had to keep interest rates high to the point that, it tilted the economy into a recession. So anyway, so there you can see when the 2-year, 10-year yield spread inverts. Okay, so the inversion is shown here. No, every time it goes below 0, that implies an inversion. You will notice, no, every time that happens, a recession comes. So the recession is the gray shaded bar. So this time you can see that it is super inverted, similar to the 1970s. Okay. And I think this is important to point out. Since the start of the yield curve inversion, how many months does it take for the recession to start? And you can see that that's why they always say rate hikes work with long and variable lags, because the shortest was 6 months, but the longest is 33 months. The average is 18 months. So for this time around, the inversion began, I think, some would say March, but then we chose July 2022 because that was, when it was like really sticky at the inversion. And you do the math, we're just maybe 12 to say 16 months. So yeah, if we're going to do 18, then, second half of this year, or, early 2024, it can happen. Still within acceptable limits, in other words. And then, the other indicators, okay, so the Fed loves to use the unemployment rate. Okay, but, and it in some ways it makes sense. There's some logic to it, because your unemployment rate has to go up for consumers not to spend. But if you look at this, unemployment is a lagging indicator. And again, the gray bars are times of recession. And you notice that usually the unemployment rate is the lowest, a few months before the start of a recession. Okay, so for us, that's not a very good indicator to look at. Instead, we look at other indicators that are the real leading indicators. Like the US has 10 leading economic indicators, and this one, as you can see, is extremely negative. So every time it's negative, again, you have a recession, and now it's there. It's super negative. And again, another leading indicator would be the tightening of credit standards. Banks have clearly tightened their lending standards, and I think with the SVB, Silicon Valley Bank event or closure, they've tightened it even more, because right now their banks are encountering liquidity problems, huge mark-to-market losses. So I don't think they have the appetite to lend aggressively right now. No, and then I think, for me, the biggest risk is, never mind if US stocks are cheap because people are already pricing in the recession. Unfortunately, they are not, because as you can see here, if we look at the PE band of the S&P 500, the market is actually trading at a very high level in terms of PEs. So it's one standard deviation below the mean, meaning that, the risk reward is not very attractive.
Okay, so correct me if I'm wrong, April, but you're basically saying that, because a lot of people are saying, okay, recession, we've been hearing the word recession for the last 12 months or so. So you're saying that the fact that it hasn't come yet at this point is just in line with historical lags, right? Now I mean, it's really normal to have that long of a lag between the rate hike cycle and the eventual inevitable, so far historically, recession. Is that correct, Ethan?
Yes, that's what I mean.
Okay.
It's like parang boy who cried wolf eh.
Yeah.
It reaches a point where it's not gonna happen, then all of a sudden it happens,
Okay, so the next question is, okay, so let's say they enter a recession. Some people are then arguing what about the argument that, okay, when they enter a recession, the Fed would then cut rates, and then it's going to be good for stocks. I mean, what's your view on that? I mean, how that impacts?
Yeah, we also took a look at that, because that seems to be a very good argument. And unfortunately, history has shown, when there is a recession, of course, that would force the Fed to cut interest rates. And unfortunately, when they do that, the market doesn't go up, because I think the focus now will be the earnings that are very weak, and that would matter more compared to the falling interest rates. So the focus shifts from interest rates to actual earnings of corporates. And by the way, I just want to highlight, for example, in the US, we're now actually seeing earnings on a year-on-year basis being down. I know that if you watch the news, they will say a big percentage of the companies are beating expectations. That's true. But the year-on-year change in earnings is negative. And for 2024, I think there is meat for the market to go down, because the consensus expectation is that earnings next year would be up by around 10-11%.
Okay. So can you tie it all back to the Philippines? Because I've noticed so far we've been talking about the US market and the recession and the potential drop in the S&P. So how would the Philippines be affected, just in case what you're saying is really gonna happen?
Yeah, I think, of course, my hope is that we will decouple. Unfortunately, I don't know what kind of of course, there's always a possibility that the US will not enter into a recession. We're just basing our concerns on what has happened historically. But, again, if history were to be our guide, unfortunately, every time the US, goes into a bear market, the Philippines is negatively affected. I think that is my main issue, which is why, even during the start of the year when we had our market outlook event, I was telling our investors, to keep some cash, some powder dry, so that if the market goes down, we'll have an opportunity to buy stocks at an even cheaper level.
All right, all right. Okay, but I guess as a follow-up to that, then shouldn't we just, should we just, are you saying that we should just wait for that day to come? I mean, for the recession to hit, for the US recession to hit, not the Philippine recession, but the US recession, US goes down, sell off in the Philippines, and then should we then just buy? Or, I mean,
Yeah, I think, that really is a very good question, because sometimes I can ask myself that as well. But there are many reasons why I think it would be wise to kind of get your feet wet early. First of all, because we don't know when the market will bottom, so it's kind of tough. And secondly, you can't get the volume. Okay, so I think now is a good time to talk about that. Okay, for example, we know that the past 2 weeks the market rebounded, and of course it was rebounding very strongly. Okay, so psychologically, I think it's very difficult for investors to actually catch that rebound and to get the size that they want. It is very frustrating to buy when the market is rebounding, because the volumes right now are very thin. And if you look at the postings, you might have to buy up. And psychologically, I think it is very difficult. And secondly, when the market actually starts to recover, remember that the economic numbers are still going to be very bad. And I think there will be a lot of hesitation as well when you try to catch those recoveries. And because the volumes are so thin, the volatility is going to be very, very significant when prices are going up. And, there's no guarantee that you can get a better price.
Okay, so you mentioned earlier, a couple of slides ago, that you think that the Philippines has better fundamentals. No? So could you expound more on what you mean by that?
Okay, yeah. So I think the most important thing that may make the Philippines more attractive to foreign investors when, let's say, the US does enter into a recession and has a bear market is, they will again look at the Philippines and say, hey, this economy is a very domestically driven economy. As you can see, for example, in our 2022 GDP breakdown, domestic consumption is 73% of the economy. Okay, and net exports is negative 11%. So see, we're really not that dependent on foreign. So if you go to Bloomberg, you look at the recession probabilities, the probability of a recession in the Philippines is probably 15%, no? Whereas the probability of a recession in the US, even now, given the very positive consensus view, is still at 65%. Okay, and that's because we are a domestically driven economy. And actually, if I look at the historical consumption growth drivers, such as OFW remittances, you look at it, OFW remittances during the first 5 months of the year still up by 3.1%, no? Still very healthy. And the IT BPM sector, or the BPO sector, which you would think would be vulnerable to what's happening in the US. Well, the thing is, companies are trying to cut costs. So what happens is they go to countries like the Philippines. So we don't have the 2023 numbers because they don't really disclose it. But if I look at another indicator, which has the number of square meters taken up by IT BPM companies, it was up by around 68%, according to Lichu Property Consultants. Another favorable thing is, like the rest of the world, inflation in the Philippines has already peaked. So I think our BSP is not as hawkish as the Fed, because we already paused raising rates, even though the Fed increased interest rates, no? And the BSP actually cut bank reserve requirements starting in June 30, which from a signaling perspective is very favorable. They would say that this is actually a neutral this would have a neutral impact. But then again, I think if inflation were very high, the BSP wouldn't even cut the reserve requirements. And I think the main concern going forward, of course, is the interest rate differential. Because if the Fed continues to raise rates and then the BSP stays on hold, then the interest rate differential with the BSP and the Fed will diminish. And remember last year, the peso depreciated to 59, no? Close to 60. But this time around, look, we decided around May that, hey, we're not going to follow what the Fed did, but the peso lately has remained strong. So I think this is good news, because this gives the BSP room to, I would say, have policy independence compared to the Fed, no? And aside from that, I think this is a very important chart that our chairman, Mr. Lee, always shares with the clients. Where are we na ba in the grand scheme of things, in the stages of the market? I feel that we are already in the late stages of the bear market. So in other words, like, most of the sell-off has already been done. Okay. And why do I say that? Well, first of all, valuations are so cheap. Look at that. We're almost retesting the 2020 low when people were scared because of the pandemic. You know, when we had the lockdown, the initial lockdown, the Philippine market was sold down substantially. We're almost back at that level. I think we're at the 11 times PE level. And the foreign investors, I mean, this chart is since 2010. If you look at it, they've been selling consistently since the second half of 2019, to the point that, you know, this is not a perfect chart, okay? But that said, maybe they've sold everything that they've bought since after the global financial crisis, and maybe some more, showing how, you know, they're already gone. They're super underweight in the Philippines. And finally, the value turnover has been diminishing. This is the rolling 3-month average daily value turnover. So you can see historically, it's always above 6 billion pesos. But now the rolling 3-month average is already below 6 billion pesos. So of course, if you are a client or if you are an investor in the market, you would notice how thin the volumes are. And probably if you were in the past logging onto your account every day, probably now you just check it once a week, and probably you're trading a lot less. So these are some indications of lack of interest in the market.
Okay, so if I were to, you know, to summarize, you know, the last 20 minutes or so, because we've talked about a lot of things. So if I could just summarize, am I correct in saying that, okay, because of the last, you know, 5 or so slides, all of the, you know, the positive things about the Philippines, you're bullish, but the only issue is in the short term, investors are still prioritizing the US. And that's the first concern that we have now. And the second one is that if and when the US does in fact enter into a recession, there might be a temporary
contagion
towards the Philippine market. But outside of those risks, you're really, I mean, we're setting up, or we have what it takes to, you know, to go up considerably. Is that a fair summary of what you've said?
Yeah, I think you've got it right. That you know, yeah, looks like, I mean, we were talking about this. If I look at the risk versus the reward, I think it's a good risk reward. Less risk versus potential rewards, because again, during this time of the market, potential upsides are very significant. I mean, it's during these times when you can buy stocks super cheap. And I think the fact that you're seeing a lot of companies actually privatizing is an indication of wow, like the insiders know that, you know, I mean, our stocks are so cheap, you know, might as well take it private, and, you know, because we're going to make a lot of money eventually when, you know, the tides turn. So So, a lot of opportunities, but, on the other side, still not yet that clear. But if you have what it takes to hold on for a long period of time, then, now would be a good opportunity to actually be in the market.
All right, all right. So given all that you've said, so what would your advice be for investors?
Okay, so anyway, yeah, I just want to talk about some risk, no? Baka maging sobrang bullish naman yung attendees natin, no? Yeah. So there are some domestic risks. Of course, we talked about the US market, but then okay, we talked about the long and variable lags. Again, we may see more of the first half where the recession is again delayed, and then Fed maintains high interest rates. The BSP might be forced to keep rates high. I think domestically, that said, some of the risk naman is that the second quarter GDP and earnings results might disappoint. And this is because, of course, we also suffered from high inflation in the first half, di ba? And high interest rates. So because of that, baka the second quarter earnings and GDP might no longer be as good as they were in the first quarter and last year, di ba? And then secondly, I think one thing that is worth monitoring in I think globally, not only in the Philippines, is that global warming, El Nino, and the impact that this would have on inflation, and the Philippines, the tight power supply situation. So domestic inflation might be an issue, but this is more of discouraging, or not naman discouraging, but this would maybe delay any potential recovery of the markets. But okay. But anyway, so that's why my recommended strategy, I think this is something that I also shared in our first half economic briefing. It's still the same. I'm still conservative. I'm not yet saying, let's go all out and be aggressive and buy everything in the market. Still think that we should keep some cash. Preferred strategies: buy on dips, sell on rallies. The stocks aren't going to run away. I'm still very focused on value. I think value is very important. If stocks become expensive, I think it's good to take some profits. And again, the focus should be on the larger cap, more popular issues, because most likely they will be the first ones to go up. And again, if your stock would give you income or dividends, then that should be preferred. And I think a lot of our clients are doing that already. In the client survey, they said that they are preferring income, dividends, REITs. Yeah. And of course, in case a recession comes, we know that the Fed will be forced to cut rates. The BSP will follow suit. And that would be good for fixed income. And anyway, this is just to say, what do we mean by having some cash? So this is not, we are not recommending you to have this type of portfolio allocation, but this is for, sample purposes only. Let's say the standard portfolio is 60% stocks, 40% bonds. What we are recommending right now is for you to reallocate some of the funds that you used to have in stocks to cash, because there could be opportunities to buy at a cheaper price if we see some of these risks materializing.
All right, okay. Yeah, so yeah, yung pinakahinihintay ng lahat, your stock picks. So could you share your stock picks?
Yeah. So yeah, these are our stock picks, and if you notice, they're basically the same. Those who follow our Calling the Shot stock pick list, we come out with them every time. I think the main difference this month compared to last month is that we removed Jollibee. Okay, and later on, I'll show you according to themes para medyo naintindihan nyo what was the thinking that I had when, just recommending the same things. Well, first of all, one of the things we talked about is the falling interest rates. And who will benefit from falling interest rates? Well, the REITs would benefit. And our favorites are A-REIT and C-REIT, no? Property companies would also benefit. And of course, Ayala Land is like the bluest of the blue. And Robinson's Land, the reason why we like Robinson's Land also is because I think around 40% of Robinson's Land's revenues actually come from malls. And right now, malls are beneficiaries of the reopening of the Philippines and the resiliency of consumer spending. And it's, again, we actually like SM Prime. The problem is it's not as cheap. But Robinson's Land is a much cheaper option, trading below book value. And I think single-digit PEs. Let's look at this table. As you can see, single-digit PE below book value. So that's really very cheap, and it provides you a 3% dividend yield, no? Okay, we also like power companies and telcos, okay? Because power companies would give you much higher cash dividends, and telcos also would give high cash dividends of around 5 to 6%. Okay, then let's talk about the risk of potential GDP earnings disappointments in the second quarter. That's why we think also you should have a little bit of defensiveness, no? Which is why we're recommending, power companies or utility companies, and our top pick would be Aboitiz Power. And on the other hand, because we're worried nga of potential GDP and earnings disappointments, we think investors should take profits on, for example, Jollibee. We think Jollibee has gone up, has been one of the strong performers this year, and we think now is a good opportunity to take profits on that. Same goes for BPI and BDO. Those are, banks have done very well this year. And I think it's a good time to take profits on them, because those are close to our fair value, if not already there. If you want to still invest in banks, you still have Metro Bank, which is one of our recommendations here in the large cap value. And then those that are, if you want to take advantage of resilient consumer spending, those that are still trading at good valuations are SM, GT Cap, and Pure Gold. So anyway, I just want to talk about the potential earnings disappointments. Okay, as we discussed earlier, one of the risks that we're seeing is El Nino and rising commodity prices. And of course, earlier on, we talked about inflation in the first half. So because of that, we're a little bit less bullish on consumer companies, especially consumer manufacturing companies.
Okay, so I just noticed, you mentioned, telcos, right? You're positive on telcos, but how come it's empty? I mean, what are your thoughts on the specific names? Yes.
Oo. Kasi, the telco sector is, it's complicated. Because, okay, it's true that the dividends, okay, Globe and PLDT give you high cash dividends. Okay. So I know this is a busy slide, but we'll just talk about it. This is just a super summary, because anyway, it's tough kasi pag inisa-isa pa natin eh. So both of them give good cash dividends, good income. But my main issue is right now, I don't see much of a catalyst for both. So in some ways, we want to recommend a stock where, it's easy to sell to fund managers, or fund managers would be excited about buying it. And the thing is, parang hindi exciting yung mga stocks. For example, PLDT Globe, they give high cash dividends. But, in terms of, for example, the mobile phone industry, it's already mature. So very slow growth. And sometimes they even talk about inflation having a negative impact on subscriber top-ups. The last few years were very good for the telcos because of the fiber broadband business. Unfortunately, this segment is also maturing. earlier on, like let's say a few months ago, people were very excited about Globe because they said, oh, GCash would have an IPO. But then when we met with Globe, what they said that, oh, they misquoted the president saying the GCash IPO. They said we don't need the money. And since valuations are kind of low right now, we're not gonna do an IPO. So they're just saying what our chairman is saying, or it means by saying we can do an IPO is, yeah, we're ready to do an IPO anytime. But we're not gonna do it, And yung PLDT naman, they have this issue about the budget overruns. We think it's really very cheap. The problem is, investors are a little bit wary at this point because of what happened, no, the budget overrun issue. For Converge, if I think about it, Converge has a possible catalyst in the prepaid broadband. That would be very interesting in the next few quarters. But right now, it's still early days. There could be some execution risk. And I don't think it will benefit from the search for yields or the falling interest rate because it does not pay any cash dividends. And then another interesting that we learned from the Lichu property consultant's briefing was that he talked about a possible overrun or possible oversupply of data centers. Okay, so one of the things we were thinking of that could be possible catalyst for, say, Globe or PLDT was that, the demand for data centers is going up because of AI. Diba? So they could be potential AI plays because of their data center business. The problem is, sabi ng Lichu property consultants, right now there is a potential oversupply of data centers in the Philippines because apparently the past few years there have been 39 companies, I think, that are in varying stages of putting up data centers. So there could be an oversupply here. And sabi niya, the second problem is, of course, we have a tight power supply situation. And we know that data centers are very power hungry. So where are they going to get the power to power up their data center? So that's another issue. Kaya parang walang catalyst in the near term.
I see. So yeah, so parang may kanya-kanya silang headwinds as of the moment. All right, so last question, last question, April. How about the other power companies? So you mentioned bullish on power, but you only mentioned AP. What about like ASEN, FGen, even SCC?
Yeah. Okay. So yeah, ASEN is interesting. In the sense that, first of all, it's a play on renewable energy. And we know naman that was uso, diba, during the pandemic 2020, 2021. And that was the reason why it went up substantially. And then indeed, it has a good long-term story. I mean, imagine right now, its attributable capacity is around 4,000 megawatts. It's on track to hit 6,480 to 2025. I think the 2030 plan initially was 10,000. I think now they've revised it even higher. And, recurring profit growth is quite substantial. Okay, from 4.5 billion to 13.1 billion. That's a big growth. Okay, so this is the fastest growing power company in the Philippines. And finally, now we're seeing capital appreciation potential. So just recently, George Ching, who is our very conservative property analyst, upgraded it to a buy. I think the main thing to watch out for in ASEN is, the price of coal, the price of oil, no? So the reason why ASEN was popular before was, of course, you saw the prices of oil and other commodities go up before because of what's happening in Russia, etc. But now mababa siya. Okay, so I think for investors who are interested in ASEN, you have to look at the prices of commodities. I think the concern right now kasi is if the global economy goes into a recession, then maybe these commodity prices could stay weak also. So So that said, baka wala pang catalyst for ASEN. Okay. So, but anyway, for those who are interested in ASEN, I think you should look at yung mga coal and oil prices. And then FGen, this is also a play on clean energy naman, not renewables, because they're natural gas. So natural gas is not a renewable, but it's a clean energy. And then, but the difference is they have stable core operations. All their capacity is has a take or pay contract, and they own 46% of EDC, and EDC has 80% of its capacity with contracts. Okay, and right now there are, of course, the main issue facing first gen is the depletion of the Balampaya gas field. But because right now there's a moratorium on new coal power plants, first gen's LNG regasification project has become more feasible. No? And finally, valuations are very attractive. It's trading at 5.5 times PE, so very cheap. Capital appreciation potential 6.1%, dividend yield 3.5%. So, you know, very attractive. But our main issue is, of course, it has a low free float of 11.7%. And right now, given the trend of companies taking advantage of cheap valuations to take their companies private, you know, I mean, think about it. This company could, you know, potentially be taken private because the free float, you just take away 1.7% of the free float, then they might be forced to go private. So just risky on that respect, you know, potential privatization. And then a while ago, you talked about SEC. You know, we didn't talk about it here, but I think, you know, we should view it similar to ASEN because, you know, if commodity prices go up, we have to remember that is a beneficiary because a big chunk of the earnings come from their coal exploration business. Yeah, but I think, yeah, talking about commodities, I think the outlook for coal and oil is very positive. Going forward, maybe 20, it's more of a 24, 25 story, but you know, look at the commodity prices because yeah, the dollar is weakening. So I mean, we'll see. But yeah, if you see commodity prices going up, then you know, SEC is another good candidate to buy. It has a good dividend yield. I was kind of surprised the dividend yield is actually 13%.
Yes.
So yeah, and then 3 times PE.
All right. Okay. So with that, I'd like to thank you again, April, for sharing your insights. Now, we'll see you in the Q&A segment, of course.
Yeah.
Okay.
Okay.
So thank you, April.